Hello and welcome to Chapter 7, which is the last chapter that we'll be covering in this class. This is really talking about variable costing for management analysis. And really, we're going to be talking about absorption costing, which is the normal costing method that we use for GAAP. And then we're going to be talking about variable costing. And when we mean variable costing, we mean variable costing not only for manufacturing, but also for SG&A. So we're going to break it down into fixed cost and variable cost for the whole entity. So you can see in absorption costing, this is our typical GAAP income statement. We have sales, cost of goods sold, gross profit, SG&A, and then operating income. And so what that does is that provides us a yearly, monthly, quarterly income statement, depending upon all of our fixed and variable costs. But variable costing, we're going to be looking at the cost in a different manner. And it's sort of like when we looked at break-even analysis. So variable costing, of course, consists of direct materials, direct labor, variable factory overhead. So these are costs that we would not incur if we didn't produce any products. So you can see here, absorption cost is cost of goods manufactured, direct materials, direct labor, variable factory overhead, and fixed factory overhead. Variable costing, we're going to separate out fixed factory overhead. So we have sales, we have variable cost of goods sold, which again include direct materials, direct labor, variable factory overhead. And that's our manufacturing margin. Then we're going to subtract out variable selling and administrative expenses. So again, these are expenses that we would not incur if we didn't sell and produce anything. And that gives us back to contribution margin. We've used that contribution margin to help pay for these true fixed manufacturing costs and true fixed selling and administrative expenses. Again, these are expenses that we would have no matter if we produced 1 unit or 10,000 units. So again, manufacturing margin is sales minus variable cost of goods sold. Contribution margin is manufacturing margin versus or minus variable selling and administrative cost. Now there is an impact depending upon how much inventory you produce. If you produce the same amount of inventory as you sell, then the absorption costing and the variable costing are going to give you the same amounts. But if you produce more units than you sell, then your absorption costing, your net income is going to be higher than under variable costing. And the reason is because you're now spreading those fixed costs among more units. So if you produced 15,000 units and only sell 12,000 units, you would be spreading that overhead across 15,000 units. But in variable costing, you would only be spreading it really across 12,000 units because that's the number of units that you're going to sell. The opposite is true if you produce less than what you sell. In that case, you will be spreading that overhead among less units. So that would create a difference in your variable costing and your absorption costing. But you can see here that variable costing when manufactured units exceed units sold. So here's variable costing. We've got 600,000 of sales. And so that's what our revenue is. And then our variable costs are just going to be 15,000 times 25, and we're going to subtract out the ending inventory. That gives us a net of 300,000. So that's a manufacturing margin. Our variable costs are $5 times 12,000, 6,000. So our contribution margin is 240, and so we have $200,000 of overhead. So our operating income under the variable costing is only 40,000. Under the absorption costing, of course, we're going to be spreading those inventory costs or the overhead among more inventory or more units, and part of that is going to end up in inventory, which we will sell, of course, hopefully the next year. But under units or less, it's difference. So in the last example, we had the variable costing first, and now we have the absorption costing. So absorption costing, again, we've got sales of 750. We've got beginning inventory plus cost of goods manufactured, total cost of goods sold. So that's our gross profit, selling SG&A. So under absorption costing, our net income is only $50,000. But under variable costing, again, we actually made a profit of 100,000. So just realize that if you manufacture more units, you're going and everything else stays the same, you're going to be spreading those costs across more units. And again, the opposite is true if you produce less units than what you sell. Here's sort of a picture here that kind of gives you that those results. And so, why is this important? Well, what's important is that you can, as a production manager, you could actually, or as a CEO, you could actually produce more units, so that in this year, by producing more units, you're selling less. You're taking some of that manufacturing overhead and putting it into next year's sales. So you could artificially uh, be increasing your net income as reported under GAAP. And so here's sort of an example of 20,000 units to be manufactured. And you can see here that the, excuse me, um, you can see here that under proposal one, where you produce 20,000 units, your operating income is going to be $200,000. But if you are going to be producing 25,000 units, your net income or operating income is going to be 280. And that's again because you're spreading the um, fixed cost among more units. However, you have now put more units into your inventory that you have to sell. And then here is sort of a variable cost. And you can see that no matter how many you produce, because you're only allocating that depending upon your variable cost, and you're not taking into account your fixed cost, the operating income from your variable cost standpoint is going to be the same. Because in each case, if you don't sell all these units, those units go into inventory and aren't counted either revenue or expenses. So you can see here again that it's a decision that you have to make because in some cases, maybe you think you're going to sell more next year. And so you want to try to hit that optimum point where you're utilizing your manufacturing processes um, to the best of your ability. So you want to be using them efficiently. So you need to figure out that point where you are utilizing, you are maxing out your production. That's assuming that you'll be able to sell these. So a lot of times, um, from what I've read, if you're at 80%, that's considered really a good point because you can't manufacture 100, 24 hours a day, 365 days. You've got to have the maintenance of equipment, etc. So it really is a decision by the corporation. Again, all costs are controllable in the long run, and that is depending upon what your capacity is going to be. In the case of Chick-fil-A, they decided that adding a second drive-through makes sense. So they've increased their capacity, but those are controllable costs. So they made that decision. Non-controllable costs are costs that another level of management controls. So basically, controllable costs here are the ones that you as a production manager, if that's your position, you can control those. But if there are other costs, those may be controlled at a higher level, and there's nothing you can really do about that. You can see here that variable manufacturing costs are controlled by operating management. In contrast, fixed manufacturing overhead costs, such as the salaries of production supervisors, are normally controlled by a higher level of management. And of course, you will budget. If you're going to be budgeting for your department, that's how you're going to budget it. In the short run, fixed costs cannot be avoided. So pricing products, you have to know how much it costs so that you can price your products. And then you have to know, you have to be competitive with the market. You can't just go, well, hey, I'm going to set up this manufacturer and I'm going to price this and, I'm going to just assume that the consumer is going to take that. That's not the case. You can't be, you know, selling an iPhone 14 for X amount if Samsung is selling an equivalent phone for $200 less. In the short run, planning production is limited to existing capacity. So again, Chick-fil-A, when they only had one drive-through window, was limited to capacity. But by adding a second drive-through, they almost doubled their capacity. Now they do have space inside the restaurant for people to come in. So maybe they increased it by a third or more because you may be able to get more people through that second drive-through window. Another use of this, of course, is you analyze market segments. You want to analyze by customer. You want to analyze by geographic area. You want to analyze by product. And so what this is going to entail is that you look at all of the components here, not only the cost of production, but also the cost of distribution and the cost of advertisement. So you want to determine what it costs you in true cost and what your profitability is. So here you can see that we have two fragrances, Camelot Fragrance Company. And so for this Guinevere, we have sales of $90,000, and Lancelot, we have $70,000. And here are the production costs. Okay, 12% for both. Promotion costs cost more for Guinevere, less for Lancelot. And then sales commissions are more for Guinevere versus Lancelot. And so when we get down to it, we can see that our margins are much higher for Lancelot. 70,000 sales, although sales are less, cost of goods sold are the same on a percentage basis, but our promotion costs are more and our sales commissions are more. So when it gets down to it, we are going to make a lot more money on Lancelot. So we would have to determine, well, do we want to be in this uh, industry or should we increase our Lancelot business? And these are the types of questions that accountants can answer by looking at the variable cost of the different products. And Adobe, this is something they came out with, here's how much they make on these three. So, publishing and advertisement is hardly anything. And digital experience is, a couple $1 billion. But digital media is where they make most of their money. Amazon, the same thing. If you look at Amazon sales, most of their money is really made from cloud services. And yet, how would we survive without Amazon being able to just call up and order a product? And so here are some of different market segments, geographic, product, iPhone, iPad, Mac. Boeing is different types of aircraft. Comcast is cable, networks, etc. So each company has different product lines or geographical lines they would want to look at. And you could do this for service business as well. If you had different plumbing uh, business or air conditioning businesses, you could say, well, do I want to go commercial? Do I want to go um, consumer, et cetera? And then I'm going to be able to, I want to look at all of these. Here is Blue Skies Airlines. And so they are going to divide their cost into two different categories. One is going to be based on miles, gasoline, fuel, of course, and then wages because they need people to staff these airlines, and that's dependent upon how far away they are versus rental or food and beverage, of course, would be dependent upon the number of passengers. So would selling expense, so per ticketed cost. And so what they're going to do is they're going to break these down into, well, here's our revenue. Here's all our fuel and wages, et cetera. And so here's our contribution margin to pay for our overhead. So we made $938,000, or maybe that's millions. Okay. Um, but if they look at where they're making their money, you can see that the average ticket price is 400 from Chicago to Atlanta, 1,000 Atlanta, LA, 805 LA to Chicago. And you can see the total passengers and then total miles. So fuel is going to be per mile. So we're going to multiply per mile times the miles flown. And we're going to have wages of $30 per mile. And then we have food and beverage and selling. And so we're going to multiply this and we're going to look at how many passengers and we're going to come up with. And now you can see that the most profitable segment is going to be Atlanta to LA. And they can use this maybe to tweak their pricing and hopefully increase their profitability. And Chicago to Atlanta, it's really kind of a money loser. Now, do they need that because their passengers expect them to do this? That's a good question. And that's something you have to look at the marketing aspect. So that's really it for this chapter. You can see here, again, absorption costing is what we look at for GAAP. And the variable costing we're going to look at the variable cost, total variable cost, no matter whether it's manufacturing or whether it's selling, administrative cost. And then we could do a cost volume analysis and say, well, how many units do we need to produce to pay our overhead? And that would give you a truer picture than just looking at your manufacturing.